got a few others that have just joined us, so we are going to dive into it. Quick recap, my name's Tony Barbone. I'm one of the directors of Private Mortgages Australia, and today I'm going to be chatting to you about how to get development finance. Okay, so let's have a look at what today's session is going to involve. So first and foremost, what we call the bank problem. There's a lot of reasons why people can't get traditional finance from a banking institution. When I say, I'm going to probably refer to banks as traditional lenders today. When I say traditional lenders, I mean big banks, little banks, non-banks, and institutional investors. Institutional lenders, and then that's sort of the first camp, and then private lenders are in the other camp. So we're going to be looking at the bank problem, but it's really more of a problem to do with traditional lenders. We're also going to be looking at why someone would want to turn to a private lender such as Private Mortgages Australia when the banks do say no. So we're going to be looking at all the different ways that we can help, and looking at the different types of situations and the different types of borrowers that we can help. Of course, today we'll be focused on development finance, so obviously the types of developers and situations that we're whittle down what it does really well. And so we've come up with a suite of solutions, and we're going to be talking in a little bit more detail about how our solutions really can be, how we've really designed our solutions to help the developers. And finally, what we call the PMA Way. Not all private lenders are created equally, and we're going to be talking about what really differentiates PMA from other private lenders in the marketplace. So let's jump into it. So the bank problem. As I mentioned earlier, in Australia, we've got sort of what I call two camps. You've got traditional lenders on one side, and you have private lenders. And when I say traditional lenders, that's big banks, little banks, non-banks, and other institutional lenders. And then in that camp, and in the other camp, you have private lenders. And the private lender camp is very fragmented. And the reason why the private lending camp exists is to really help those that have fallen through the cracks from the traditional lenders. So we found traditional lenders are very rigid. They're very restrictive in their lending guidelines. They are, typically, we're talking about banks with, billion-dollar portfolios. And so really the way it works is it's very policy-driven. You have to sort of fit within these certain parameters. And if you don't fit within those parameters, then you fall outside of the system. It happens all the time. So we've also found, when you are dealing with a massive behemoth like a big bank, there's lots of departments, and there's lots of people working in those departments. And a symptom of that is that they're very slow to settle. We've seen it time and time again when developers come to us and they're like, "Oh God, the bank has just the bank's got me in limbo. I've been in limbo for weeks. I don't even have a decision yet." Happens all the time. So we've actually, one of our solutions, we'll be talking a little bit more about some of the solutions that we've developed over the years, and how we can really help out people who are in that sort of situation when they're stuck in sort of bank limbo. Now, traditional lenders, banks, they like to write loans for 25, 30 years. And it doesn't always meet everyone's situation, especially when you're doing a development project that might only have a requirement for finance for around sort of 12 months. We're not really comparing apples with apples here. Okay, so your traditional loans are really established for the long term. Then that's why the banks want to look at serviceability to make sure that you can afford the monthly payments, and the plan is to pay it off over the course of 25, 30 years. Very, very different to how private lending fits into the picture. Our loans are between sort of 3 and 36 months. So that's we specialize in the very short-term side of things. Now, probably one of the most important things I want you to sort of take away from today is what we call the department trap. Okay, so there's a magic number in the traditional bank land, which is 4 and under. So if you're doing, let's say you're doing a 4-unit development or 4 townhouse development or 4-lot subdivision, like a small residential project, if it's 4 and under, it stays in the domestic department. If it's 5 and above, it moves over to the commercial department. Okay, so what this trap happens here is that if someone is in the domestic, getting their finance application reviewed by the domestic department, First, they follow a certain procedure, and what that is, they look first and foremost at the borrower's serviceability. Okay. Now, what happens is a lot of borrowers don't have the ability to take on the additional. They don't have the serviceability to prove. They can't prove the serviceability required to take on the additional debt load. Okay, so if you're in that domestic department doing a small residential project, you're going to get reviewed that way. As soon as you move into the commercial department, they use different procedures. They look at usually capitalized interest for larger development projects. Okay, so the net result is that banks say no a lot. Okay, they've got a variety of different reasons. The big one is usually serviceability and the short nature of these types of projects that people are trying to get funding from the banks. And usually they hit that brick wall and they go, okay, what else is out there? I've got a profitable project here and I want to move forward. What else is there out there? Okay. And this is why people turn to private lenders such as PMA when the banks say no. So as private lenders, the way I look at private lending is it's just problem solving. Okay. So we're really dealing, the borrower, the developer needs to usually go to the traditional camp first, and then when they've exhausted that as an option, and they still want to move forward because they've got a really good project, for instance, it's going to be quite profitable, then they can look at the private lending landscape. Okay, and then this is where we like to stand out from here. So we really need people to go and get a dose of reality before they come to us. Okay, so we're not focused on serviceability much like a bank. Okay. We don't look at any serviceability. We are asset lenders in the sense that we're more interested in the asset value, the loan to value ratio, and the exit strategy. How are you going to pay the loan back in a relatively short period of time? Our average loan is 8 months. So if we lent you all this money, how are you going to pay it back in such a short period of time? So that just needs to be contemplated. All of our loans come with prepaid or capitalized interest. Okay, so there is no service. This is why we don't look at serviceability, because it's all built into the loan. You receive your, in an oversimplified example, you receive a large sum, a lump sum of cash at the start, and then you pay back a lump sum of cash at the end. Okay, you don't have to service interest along the way. It's not necessary. It's all built into the loan with capitalized interest. Now, I skipped this one, but yes, it is still possible for people that do have some credit blemishes to get finance from us to help fund one of their development projects. Not a problem at all. We live in the real world. We understand that things do happen in people's lives. A lot of the time, if there's like a telco bill or an unpaid council rates, something's happened along the way. It's really simple. We just make sure that there's an allowance at settlement and that gets cleaned up at settlement. And then it just allows the borrower to go through the process of getting all that struck off their credit file. And then in a few months' time, that once they've got a clean credit file, then they can look at, refinancing to a sort of a mainstream lender, a traditional lender. So all of our loans, they come with a component of prepaid and capitalized interest, but they also have monthly extensions. We do live in the real world. We do know that sometimes, in the world of developments, things sometimes unexpected crop up and people need to extend for, on a month by month basis. So all of our loans, we allow extensions. So it could be, at the end of, say, a 12-month prepaid term, the 12 months prepaid capitalized interest is all used up and they just need to extend for another 30 days. Not a problem. At that point, they can just pay 1 month's interest in advance and roll the facility over for another month. There's no penalties involved with any of that. It's just paid at the lower interest rate. We're very proud of announcing, we announced a few months back that we have a 4-hour guaranteed response time. I'm not sure of anyone else in the marketplace that does this, but as long as someone completes our online quick app, we can have an indicative letter of offer to them within 4 business hours. That's on Melbourne time. Or a quote if we haven't got all of the required information, like the names of the borrowers and all of the actual property addresses and that type of thing. If we've only got basic information to work with, we can only provide a quote. But if you fill out all of the quick app in thorough detail, we can have an indicative letter of offer out to you within 4 hours. Settlement within 5 days. Now, this is subject to all of the required information that we need, but as soon as we have all of our ducks lined up, we can settle very rapidly. And of course, developers love coming to us because we don't have a requirement for pre-sales. We specialize in those smaller development projects, as I've already touched on. 4 and under, people in that domestic department trap. Sometimes they can get finance from a traditional lender, but the traditional lender will impose pre-sale requirements. Okay. And a lot of the time for this, the way we see it is these smaller projects, we don't really see the point in needing to get a pre-sale. If a developer wants to speculate into the market and build a product that they think the market will accept, and that can be justified, through local agents and valuation reports, that's fine for us. We don't really see the requirement for a pre-sale. Sometimes developers like that because they know that they can get a premium on what a pre-construction valuation says, and they know they can get a premium, so they want to speculate into the market and get that upside. Okay, so we've got no problems with that. If we were doing 80 10-story buildings with 60 apartments in it, that's a different story. It's a different type of business. In those situations, I think pre-sales are required from construction funders. But for the smaller projects, 4 and under, we don't see really much point in that. We want our developers to be able to maximize their profits on a project. So who can PMA help? So we love working with aspiring developers that are transitioning out of sort of full-time work. So they've got serviceability that's sort of behind them. They've made the plunge and they're moving into the world of becoming a full-time developer. Often they have very lumpy cash flow. So they can't prove as they're sort of moving up the yield curve, they're moving from, renovations, moving up, sort of doing like a renovation flip type of project to like a multi-unit project, and further they go. In this little part of the, as they move up that yield curve in the finished product output, they don't have the serviceability to show the bank. So this is when they get stuck, and then as they sort of move up and progress, they move on. But we love building long-term win-win relationships with our developers, and we love it when they come back and use us again and again. That way, it's a great outcome for everyone. So we help out in situations for land purchases and construction, land subdivisions. We like those. As I mentioned earlier, the 2, 3, or 4 townhouse developments or unit developments, renovation or flip projects. We like those. Small apartment complexes, sometimes mixed use developments. They kind of, with a little bit of commercial, a little bit of residential, they can be a little bit difficult for traditional banks to wrap their head around. So we have an appetite for those. We've certainly done those in the past. And build to keep. We see this all the time. Sometimes the traditional lenders, if they can, they are prepared to offer finance, but they want to do it on the basis of pre-sales. And so the developers aren't prepared to accept that. They want to keep the product for the end product for the long term. And so, build to keep is, we definitely help out some developers that want to manufacture their profit, and they want to keep it for the long term, for long-term wealth generation. So moving on. So here's another really critical slide that I want you guys to take away today. Now, as a self-confessed finance nerd, this is how I view a development site. I don't picture hard hats and tools, that type of thing. I just don't look at it that way. I look at it like this. And so what you have is, I could probably spend a couple of hours just on this slide alone. So I'm just going to give you the really high level point. So down the bottom of the stack, that's the senior debt provider. That's the most secure position to be in. It provides most of the funding. It's the last party to put money into a project and the first party to pull money out of a project. Okay, they get the lowest rate of return, which is in the form of an interest rate. Okay, most risk-averse position is down the bottom of the stack as the senior debt provider. The next level up, they're taking on a bit more risk. They get compensated with a bit more rate of return. Okay, they're putting in far less into the project itself, and they are the second priority, and they'll get their money back. It's subordinate to the senior debt provider down the bottom. So taking on a bit more risk, they're putting in far less capital into a specific project, but they get compensated with a higher rate of return. As you move up the capital stack, taking on a bit more risk, you get what's called preferred equity. So this is equity that comes in. It's not debt. It's equity that goes into the project, and it gets paid back in preference to the common equity providers. The common equity providers being the developer's cash that goes into the project. Now, what I want to say to you is that what we have seen in the past is that common equity or pref equity, that is a very expensive form of capital, because a lot of the time it's giving away profit. So let's say you're doing a small project and you need to raise $250,000 in the form of equity. You decide to raise $250,000. Let's say you need $500,000 for the project, cash to go into the project, and so therefore you want to get an equity partner to put in $250K, which is half the equity required, and you're prepared to give away 50% of the profit. Now, that's really expensive. So it might be cheaper in terms to get a private lender that has a higher interest rate, because ultimately at the end of the day, you're only going to be giving away an interest rate, not half the profit. And that's the point I really want to get across, which is that what's more important than the interest rate is the weighted cost of capital for a project. Okay, you have to weigh up all those different pieces of the puzzle, the funding stack. You need to weigh up those costs, and then you need to work out what's going to give you, as a developer, what's going to give you the best rate of return on the cash bit that you're putting in. Okay, if you give away equity, it's really expensive funding. If you're paying interest, it's a lot cheaper in comparison to giving away equity. Okay, so I want you to really just bear that in mind. Interest rates almost irrelevant if you're looking at it in an isolated. You need to look at it in the total cost and the weighted cost of capital to get a project from start to finish. And private lending could be a lot cheaper alternative than giving away profit at the end. Okay, so we're pressed for time, so I'm going to keep moving, but I would love to spend a lot more time on this one. So what PMA has developed is a suite of development finance solutions. Okay, now we know we've been doing this for long enough. I started back in private lending in 2009, so we've been doing this for quite some time. We're not the 24-hour guys that charge 4, 5, 6% per calendar month. No, we're not those guys. What we've really whittled our specialty down to is this. We don't do large construction projects for 80 units in the city. That's very specialized. So this is just the little sweet spot that we operate in. So we've distilled it down to, we've got our first solution, which is the urgent settlement saver. Now this is really it's the security is first mortgages on a potential development site. We usually do this up to 12 months and up to 65% of the as-is valuation. Okay, so the next one down is the what we call core construction. In the previous slide, it was referred to as the senior debt piece. We call it core construction. Its security is first mortgage over the project itself, and these can be anywhere up to sort of 24 months. Now we're doing up to 65% of the as-if valuation price exclusive of GST. Okay, the next one is core construction support, and this is secured by way of a second mortgage over the project. So in that previous slide, this was referred to as mezzanine debt. Okay, it's a little bit more risky than the core construction piece, so it's just priced accordingly. Again, up to 24 months typically, and up to 65% of the as-if complete valuation. Now, completion support's a little bit different. It is secured by a second mortgage on the project. It's usually for a very short period of time, and it's really there just in the event of like a cost overrun. The end is in sight. They just need to get it done, and they need a little bit more cash to go into the project. And the other lender, the senior construction funder, isn't prepared to put any more money into the project. Okay, and so again, up to 65% of the as-if complete value. And when a project's done, it reaches practical completion, then you have our solution is called residual stock. Now, I know that there are other traditional lenders out there in the marketplace that are providing a residual stock solution into the marketplace, but really where they tap out is around sort of 50% loan to value ratio, which really what that means is that they're only providing so much debt on the project, the residual stock of the project, so that the rent can then service the loan interest. Okay, Where we differ is we don't look at serviceability. So that means we're able to provide a higher loan to value ratio on the as is value. Okay, so as if complete is before the project's done, as is what it's worth as is today. So yeah, and so what we're going to do, this next slide really sort of explains it in terms of an overview of the way a project goes from start to finish. Okay, so you have the acquisition of the site. We have our urgent settlement saver. I think just to mention on the urgent settlement saver is the reason why we call it the urgent settlement saver is because we've seen it time and time again where let's say a developer, borrower, they've gone off and they've purchased their project. They've put down a 10% deposit. They've put down a lot. They've signed the contract on the basis of a long-term settlement of say 12 months, so they don't have to settle on it for 12 months. They put their 10% deposit down. They vigorously, approach council and try to get the development approval through council. Sometimes they experience delays, and so then they need to, and then something might happen, like COVID might hit, and then the banks just say, "Well, we're just not lending on development sites anymore." Okay, so see that happen all the time. So usually what happens is a developer approaches us and says, "I've got to settle next week, otherwise I'm going to lose my deposit. I'm going to lose the money that I've been spending on professional fees over the last 12 months and all of my upside and profit." So yeah, we move very quickly to provide a solution to settle on the development site itself. So that's the acquisition piece. The next is the core construction or the construction support. So that's either there are solutions that happen at the start of the project. Okay. Then let's say it could happen. There's a cost overrun. We're hearing situations now where the cost of materials are skyrocketing. Okay. So, 6 months ago when a project commenced, they probably were expecting the cost of materials to be sort of consistent. Now they've gone up exponentially in price. So it could be, we're probably going to see a lot more of these projects requiring completion support because of these cost overruns, and the developer doesn't have any excess cash to put into the project. The senior debt provider is not prepared to put any more money in. They need a solution. The end is in sight. It's only a few months away, and they just need a little stopgap type of funding. So our completion support solution comes in. We provide the finance just to complete the project. And then let's say the pre-sales will kick in, but maybe, who knows, it could have been a slower than expected sales process during the construction period, and they've got some leftover property. So what we can look then is at a residual stock solution where we take on the balance of the security, so the balance of the project. We do funding against that, and what that allows then is for the developer to pull excess equity out of the project, and they can move that and push that into their next project. So it keeps the developer moving. Okay, remember we're dealing with developers, aspiring developers. We're dealing with aspiring developers that have usually got lumpy cash flow. Okay. Now I've just had a question sort of pop in. So what I'll do is I'll address the questions at the end if we still have time. I'm just mindful to try to make it as quick as possible. So here's a case study. This is a new product for us. It's called it's part of our solutions that we offer, but it's a split facility. So a borrower approached us and they needed finance to settle on a vacant block of land. Okay, so this was an urgent settlement saver solution. So we provided the funding for them to obtain the block. We ended up doing 60% loan to value ratio on that. So that was a sort of a standalone facility. Then once they settled on it, they managed to get all their ducks lined up in terms of the approvals in place, the building permits, etc. The sort of pulled all of the documentation together with the builder, etc. And so once everything was ready to go, then we provided a second facility, the core construction facility, where we were lending on the as-if complete value, so 65% of the end value. And this is what it looked like. So they settled on the land immediately. I think it was a few weeks later. I can't remember exactly how long, but it was about a month or so later. We then settled on the core construction piece. And what it is just one single first mortgage with 2 facilities split inside of that, similar to how some people split their home loan. It's just one mortgage, but it's just split into 2 parts. Okay, so this is really the difference. There's a slight premium on the interest rate that the borrower had to pay just for the construction risk, okay, which isn't there for the urgent settlement saver because we're lending on an as-is value over there, whereas we're lending on an as-if complete value for the core construction piece. In total, it was the total split facility. If you add the facility limits of both the solutions together, it's worth $717,000. And yeah, we've got a very happy borrower who wouldn't have been able to do the project because they just didn't have the serviceability to meet bank standards. And so yeah, they know that they're going to be turning a profit on this one. We don't have any requirements for pre-sales. They want to speculate into the market. A lot of the time, the way that this developer operates is they like to finish the product and then have people go in there, see, feel, touch, taste, and smell it before they and stage the end product. And so yeah, and that will ensure that they've got a little, they're maximizing their profit. And look, they're prepared to take on that risk, and that's fine. From our perspective, we think with the end value, they weren't going to be setting any records for the area. It all just made a lot of sense for us. So this is how we've made it work. And yeah, we've got a very happy developer who's we're going to do more projects with. So this is our loan to value ratio and pricing. So look, these are the different sectors that we lend on. Today's focus is obviously just on the development piece down the bottom. And part of that as well as the residential. So our residual stock facility, our residual stock solution, that's on residential as-is valuations. So we can do up to 75% on that. That's our first mortgage rates. And so R1M stands for first mortgages. R2M stands for registered second mortgages. That's the different rates that we have. So yeah, that's pretty much it. It depends what it is and where it is. If someone comes to us and says, "Hey, can you provide 80% loan to value ratio for a land subdivision in the middle of nowhere?" We're going to say probably not for us. However, if it was sort of in more of a major metropolitan area and you're only looking for sort of like a land subdivision at sort of 60% loan to value ratio, yeah, that makes sense for us, and we could provide a solution for that. Okay, so it really depends what it is, where it is. And all of the pricing and LVRs provided here for major metro areas. So over the years, we've really whittled it down. We've made a very streamlined lending process. It's really simple. So first step is to jump on our website and complete a quick app. Okay, it's very quick. It takes less than 10 minutes to fill in all of the details. Send that off. Now, that'll be received by our relationship management team. They'll run an initial assessment on that. If everything stacks up, then they'll move to issue an indicative letter of offer, and we'll provide that within 4 business hours guaranteed. Okay, now, if not all of the information is provided, then we'll send out a loan quote. There is no requirement you don't fill out any privacy declarations when you submit the quick cap. So we don't, at that point, there's no credit checks or anything along those lines. You get to see the indicative letter of offer. And if you're happy with everything that you see in terms of, rate, terms, all that sort of stuff, then only then you sign off on that. And then that's when you do your privacy declaration. And only after that point would we be able to do a credit check. Okay. So the assessment fee is $1,100, inclusive of GST. That's for us to cover the cost of all of our searches. We're going to do credit checks, title searches, etc. So yeah, that's really all involved. Then, assuming you accept the indicative letter of offer and pay the assessment fee, we'll do all of our due diligence. Then we'll move to a formal letter of offer, get everything formally approved, and then we move to settlement. So it's really simple, straightforward, very streamlined. How much does it cost? Well, it really depends. We have an approval fee that we charge. So that depends on the size of the loan. So for the larger loan amounts, the approval fee is scaled down, whereas it's a bit higher for smaller loan amounts. Now, I've already mentioned the assessment fee. It's just $1,100 inclusive of GST. Legal fees are all done at cost on a flow-through basis. anywhere between sort of $2,500 to $3,500 most of the time, depending on how complicated the documentation process is. Now, that's not us charging it; it's the solicitors that charge that to document it. The other thing is the valuation and quantity surveyor reports. Now, they're not always necessary for every single transaction, but for development type of transactions, yeah, we more than likely will require a valuation and quantity surveyor report. Now, they're done at cost on a flow-through basis. It just really depends on the size of the project, but usually between a couple of $1,000s to a few $1,000s, that's sort of where they would be. And what we do is we usually put a quote out to a few different groups that we have a relationship with, and based on sort of geographic proximity. So we use different organizations in different areas. And so what we will do is we'll put out a couple of quotes, we'll find out what the most cost-effective quote is, and we'll run with that. And we'll provide that to the borrower so that they know exactly what they're getting into before they have to pay for anything, okay? So that's it in terms of fees and charges. Oh, what I should probably mention as well is now we don't charge this to people as an out-of-pocket expense. The only out-of-pocket expense is the assessment fee, okay? The valuation and QS reports, okay? The approval fee itself, that only gets charged at settlement if the loan proceeds, okay? It just gets deducted at settlement, okay? And the same with the legal fees as well. So that's pretty much it. So we like to keep the barriers to entry very low. We don't like the idea of charging big upfront fees like a lot of other private lenders do. I'll get into more detail about that coming up very shortly. So how do we look at a loan? So we run this thing called the first filter. It's like an initial assessment. So first and foremost, we only provide non-coded finance. So in Australia, you have two types of credit. You have consumer credit, and that's for mums and dads, buying their family home, or an investment property, or a car, or getting a credit card. That's all consumer finance, okay? And you need a credit license to provide consumer finance. Private mortgages is, now the other type of credit in Australia is commercial credit. You don't need a consumer credit license to provide commercial credit. PMA only provides commercial credit. So what we call that non-coded finance, okay? So what that is, if it's a company borrower or if it's for a genuine business purpose, that's considered non-coded or commercial credit, okay? So we only provide commercial credit. So it has to be for a genuine business purpose or a company borrower for on a development project. That's the first thing. The second thing is the borrower prepared to pay at least 8.95% per annum interest rate? We get people approach us all the time and say, oh, yeah, I can get money at 6% per annum. Well, like, okay, go do that. There's usually some reason why they can't get finance from a traditional lender at a lower interest rate for them to need to come to a private lender to find a solution, okay? So, yeah, if you're trying to just shop around and get the best rate, obviously going down the private lending route isn't going to make a lot of sense. If you can go get traditional finance and you can tick all those boxes, and you can provide the serviceability, and look, if you can get it, go get it. It's always going to be cheaper than private lending. Where we differ is, usually someone's gone to that, to the traditional finance camp. They've got a dose of reality. They still have a viable project over here that they want to move forward with, and then price is no longer an issue. Okay, so that's the second thing. The other thing is postcode and LVR. Now, I mentioned this earlier. If they're looking for an 80% loan-to-value ratio, land subdivision in the middle of nowhere, we're probably not going to do it. It's not really for us. But if it's, a land subdivision in a major metropolitan area and they're looking for 60% of the end value, yeah, that's going to work, okay? Exit strategy, really important. We're not a traditional lender providing finance for 25, 30 years. If we're going to lend you money for 12 months, how are you going to pay it back? A lot of the time we get, it's the intention of the developer to build to keep, okay? So what we do is we don't look at their serviceability, but we would, it just needs to make sense, okay? So if we know that once they've built 3 or 4 townhouses, the townhouse is going to rent for X amount of dollars, we know that the bank is going to look at that and say, oh yeah, well actually, yeah, the rental from these townhouses are going to service the debt, okay? So that makes sense to us. they don't have to have an approval from a bank. It's just, they just need to just say, hey, this is what I'm contemplating. I'm planning on doing this. Does it all make sense? So that's what we look for. Does it make sense? And sometimes it's a combination. I'm going to sell one of the townhouses and I'm going to keep the other two. I'm going to pay down the debt this way and I'm going to refinance the residual debt. So this, it just needs to make sense. Okay. Now, if they're intending to do a refinance and their credit is shot and it's not looking good at all, well, then, maybe that wouldn't work for us, because we don't want to set up our borrowers, we want to set up our borrowers for success. And if they're being unrealistic with their exit strategy, we might have to say no. Okay, so it just has to make sense. Now, why can't you get bank finance? I've already mentioned this. Try the traditional camp first. If you can't get the finance from the traditional camp, come to us. Okay. If someone says I can get finance from the traditional camp, we say go there. It's going to be cheaper. And when do you need to settle? We can only move. We can settle within five days, but we can only move as fast as a cooperative borrower. Okay. Now, if you want finance from us and it's, you're not providing us really important information that we need, we can't move very quickly. Okay. So we can only move as fast as you can provide us the information. And that's our initial assessment, or what we call the first filter. And as long as all of that makes sense, then we're happy to move on to the next stage, which is issuing an indicative letter of offer. Now, as I mentioned earlier, not all private lenders are created equally. And what we've come up with over the years is what we call the PMA Way. So we have very low upfront assessment fees. We don't have any charging clauses in our indicative letter of offer, and we have no cancellation fees in our indicative letter of offer. And we've seen this all the time. Unfortunately, there are some bad apples in the private lending space that give the rest of us a bad name. And, the reason why we set up Private Mortgages Australia back in 2014 is because we wanted to take that private lending model and flip it on its head and just make it really transparent for everyone. So I've heard horror stories about other private lenders that charge tens of thousands of dollars upfront for upfront fees with no guarantee of even doing anything. The other thing is that sometimes I've heard situations where a private lender, they send out an indicative letter of offer. It has an interest rate from 1% per annum, 1% per calendar month, and then the borrower signs that. Oh, that looks good. Sign it all, get it, send it back. The private lender does all the work. They instruct their solicitors to issue the documentation. Documentation goes out. The borrower goes out there to sign off on everything, and they go look and they go, whoa, 3% per calendar month. This isn't what I expected. And so then if the borrower withdraws at that point, the private lender says, oh, no. We've got a charging clause in our indicative letter of offer, and we've got a cancellation fee. So we're going to put caveats all over your property, and we're going to charge you the 2% cancellation fee if you withdraw at this point. So what they've done is they've kind of coercing people to go in to take on the loan. And what they do is they put caveats all over their properties and hold their properties to ransom until their fees get paid. We just don't like this approach. Okay. So that's why, we don't have any teeth in our indicative letter of offer. It's all very straightforward, very transparent, easy to understand. What you see is what you get. Okay. Now, all of our valuations are done on a flow-through basis at cost. So we'll get the quote first, send it through. If you're happy with that, then we'll collect the payment. We'll pay the valuer. Okay. Now, it's done on a reasonable valuation methodology as well. These other private lenders out there, they charge tens of thousands of dollars up front, and they call them for valuation fees, but then they instruct the valuer to go out there and do a for-sale valuation. And that, what that means is the valuer gets whatever the value of the property is, and they discount it by 20%. And then, lo and behold, the loan-to-value ratio never stacks up. The private lender pockets all the money, and that's it. End of story. And the borrower can't really do anything about that. So, when we instruct valuers, we use very reputable bank panel valuation firms, and we are instructing them for mortgage security purposes or fair market value. Okay. Now, all of the legal fees are done at cost on a flow-through basis, and they're taken out at settlement. Now, all of our loans come with prepaid or capitalized interest. And I'll give you an example. Let's say that our loans are prepaid for 6 months, just a short-term loan, prepaid for 6 months, and we give them borrower 6 monthly extensions. At the end of the 6 months, they can pay 1 month's interest in advance at the lower rate with no additional fees or charges. And let's say the borrower then settles 2 weeks later. Okay, so what we do is they've just paid 4 weeks in advance. They settle 2 weeks later. We rebate that 2 weeks of unused interest. Okay, now it doesn't apply for the prepaid term, which is like a fixed rate loan with the bank. So that's sort of agreed up front. So that bit's fixed. But on the month by month basis, yeah, we rebate unused interest. We think that's only fair. So you're not paying for more than what you need. The other thing is we have custom-built software for faster deal processing times. It's how we're able to offer our 4-hour guarantee response time. We have a full-time developer behind the scenes who's always, working on improving our processes. So yeah, we're very happy and very proud of to be able to provide that to our customers. We have a high level of repeat customers. We love building long-term win-win relationships with aspiring developers that are transitioning out of full-time work to become full-time developers. We understand it's a tumultuous time because they have lumpy cash flow and they don't have serviceability. So we really, we're bridging them into that sort of full-time developer type of reality. And what we've found is we've built long-term relationships. We have developers coming back again and again. And, the idea is, as they grow with us. That's sort of the way that we look at it. We want to do a great job so that they keep using us again and again for all their projects. And what it really boils down to is we think that we have created a win-win approach to lending in the private lending space. Okay, so, that we want really good outcomes. We always are setting up our borrowers for success wherever possible. And it's all very straightforward and transparent. And, that's the reason why we keep getting, a high level of repeat customers. So look, that's it from me today. So here is the details of our general manager of relationships, Shanta Lobo. She is a career banker of 20 plus years. She's a gun. She handles all of our quoting. So yeah, if you do have a scenario, please reach out to Shanta. She'll be more than happy to, if you give her a call, spitball a few ideas around some projects that you might have coming up. She'd love to hear from you. And you can also jump on our website and get a little bit more information about our solutions, okay? All of the solutions are on the website in a little bit more detail. Now, I've had a couple of questions come through here, but they're sort of more specifically related to projects. So what I might do, I would say, look, defer to Shanta. She'll be able to talk to them in a little greater detail. And I've just got a general question here. Missed last week's presentation. Is there any recording? Yes, we record all of the webinars. We should have all of the webinar recordings out to the attendees in due course. So look, that's it for me. Thank you so much. Have a wonderful day. And we look forward to working with you in the future.